Keith McCullough, and welcome to The Pitch. All right, we have 10 analysts in 60 minutes. We're taking up 10,000 feet today. Usually we have 6 in 60 minutes, so they have to keep it tighter, and we have a little buzzer for them if they don't. So let's go to the veteran, Todd Jordan. You kick us off first.
Thanks, my man. So we're going to talk about Wynn, which is the BIC, best in class. And that will be the theme of this short little presentation. But I will say from a quad perspective, Wynn loves China Quad 1, Quad 2, and loves United States Quad 1 and Quad 2. And in fact, Quad 1 is the environment for Wynn historically in terms of the stock price performance. So BIC, what do I mean by BIC? Best in class. They are the best properties in every market they operate in. So if you go to that first slide, here's their markets: Las Vegas, Boston, Macau. We're going to show they're better. They've outperformed in recoveries in Las Vegas and Macau historically, because the best in class always seems to outperform during most of the recovery, because that's where everybody wants to go when it's on sale. You can see from the chart on the right, unfortunately, Wynn is underperformed. Fortunately for us, because we just put it on our best ideas list just about a week ago. Next slide here, just looking at the valuations real quick. You can see Wynn's trading towards the lower end of its range. And actually, if we look at 2023, which would be a normal year, they would be at the very low end of their range. And you can see from the chart on the right, Wynn is actually trading at a discount to basically the whole gaming and lodging and leisure sector. So pretty attractive from a valuation perspective. But let's get into the fundamentals here. So here, if you look on slide 7, left is Las Vegas, right is Macau. That's showing the performance that we've seen during recoveries, clearly way outperforming the market in both of those markets during recoveries. We've got evidence that they're already outperforming in Las Vegas. They're already outperforming in the Northeast region, which is their Boston property, which is fairly new. And Macau is not yet in recovery. We think it could be starting up here. We need some stability there. Once we get stable growth, even if it's slow, you're going to see Wynn outperform as they have in the past. Turning to slide 8, just a quick slide on Vegas. And I put this in here because I think it's a little underappreciated in terms of everybody can see that leisure is great in Vegas. Everybody wants to go to Vegas. There's pent-up demand. But what we're showing here is that the convention business, which is a huge part of their business, it fills up midweek room nights, which is incredibly important. You can see the outlook for what's on the books for 2022 is actually better than what we had in 2018 for 2019. So you're going to actually exceed 2019 levels for group attendance. Will be great. And the key here for Wynn, if you look at the chart on the right, they have added the most convention and meeting space out of any company in terms of percentage increase. So they're going to be able to well capitalize on that increase in convention and meetings that we're seeing for 2022. Real quick, next slide here, 9. This is just a quick look at Boston. Clearly outperforming here. As you can see, they're gaining share in the whole Northeastern market. And their share is actually growing at an accelerating rate, which is fantastic. Long ramp here. This property is going to continue to outperform and beat consensus estimates. Slide 10, we talked about Macau. This is the biggest reason why there's a discount in the valuation. What we're showing here is that Wynn is the BIC. They've got the largest room size, you can see from the chart on the left, and they've got the most premium suites and the largest premium suites. I know from being there, they are the 2 nicest properties in Macau. They will outperform. Slide 11, I just wanted to address one thing that people are looking at negatively right now is the junket business or the VIP business, because of what's happened recently with an arrest of the CEO of the biggest junket in Macau. The junket business is just not that important to Wynn. You can see from the chart on the right, it's gone down to 12% of casino EBITDA just in Macau, right? So if you look at overall company EBITDA, it's probably about 4% of their total EBITDA. So this is really a non-event. And what this doesn't calculate also is how much of that junket business, if it completely goes away, how much of that comes through the premium mass channel, which is a more profitable channel because you've eliminated the junket middleman. It takes about 20% of that business to come through to break even from a profit perspective. And then finally, slide 12, you can see there's plenty of upside. This is our sum of the parts, which we've used conservative multiples lower than historical multiples, especially on Macau, just because there may be some uncertainty here, and you've still got plenty of upside. So we like this name a lot. We think fundamentally there's catalyst. The markets are doing really well with the exception of Macau, but even that's starting to look a little bit better. November was better than October, and December should take another big step up. But at Las Vegas, they're killing it, and Las Vegas itself is killing it. They're outperforming in an outperforming market, and that's going to lead to upside earnings. We think the street's too low in Macau, Boston, and Las Vegas. And there we go.
Tight. That's how you pitch a stock. For those of you that aspire to being like our own version of MJ, we call him TJ. All right. Thank you. Let's go to who a lot of you think is just a shorter version of MJ, Brian McGough. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.
I'm a much shorter, much lighter version of MJ. So my stock here is RH.
RH. I'm shocked.
You shouldn't be shocked. This is a name. Look, we were long this thing at $30. It went to 600. That was like the first wave getting paid. So this is a multi-stage story. That was your first paycheck. If you got it, great. Knock yourself out. Don't sell it yet. Buy more of it. Now that was the company going from small galleries to large galleries, which was a huge ROIC improvement event. It worked great, awesome, love it. But now the company is moving towards building an ecosystem around the rich. It's going into everything from like house construction and house flipping to doing luxury jets and yachts to be rented and leased by affluent consumers. It's doing a guest house, which is like a hotel type. It's just this entire ecosystem around very, very rich people is where it's really going and dominating. And the point is, that's step 2 of this call. That gets you from about $600 where it is right now. Stock's been weak recently, and that gets you up to about $900. I think next year you're basically looking at 30 times earnings on a 30 multiple. Then you go to step 3 of this call, and this is what gets you paid over a tail duration. And when you look at our numbers here, we are so far ahead of the consensus on our top line numbers. I'm not saying, oh, it's just a margin story or they're going to buy back stock again and have a whole lot of value. No, this is pure unadulterated top line growth. About more than half of the world's billionaires live outside of the U.S. That's RH's customer. And what they're doing starting next year, they're taking their ecosystem around the rich, they're building it in places like England, Paris, Germany, Spain, Netherlands, and they're going global. If you look at a company like an LVMH, which is a very good peer, only 25% of that company's sales are in the U.S., and that's where RH is going as well. We did some really great market analysis. Our Retail Pro subs got this, whereby, and these are tools I use doing strat planning at Nike, whereby we went into every single market, looked at per capita spending on home furnishings by rich people in every single market of the U.S. and outlined where the growth opportunity is. The punchline is you have about $40 in earnings power in the U.S. alone, and the consensus tail estimate is only $34. So the street's not doing math or they're not doing research. Chances are they're not doing research. They're probably not doing math either. Then you tack on the international growth opportunity. Just in the markets where they're adding stores over a 2 to 3 year time period, you get to another $18 in earnings power. And then you got to double that because the company's not just opening stores, they're opening up markets. So they go into RH England, RH London, which happens next year, and they're going to open up that into, I think there's some rich people in London, right?
Yeah.
There are plenty of them. And it's a massively fragmented market over there. RH is going in at super high price points. They're going to kill it. So ultimately, I build all of that up. I get to earnings power of about $55 to $60 a share. The consensus is at $34 over a tail duration. And then you got to look at the overall return characteristics there and what the peers are. And you can't look at peers like WSM and Wayfair and these other like sub-quality home furnishing retailers. You got to look at luxury peers because that's what this company is. It's building a great moat around its core business. This is a moat that can't be crossed. It's way too wide and way too deep. It's got ROIC of 70% on its core business, on all of its business. It's got operating margin of the like mid-20s, probably had it a little higher, but let's call it mid-20s. And you got to look at companies like Hermes, LVMH, Kering, and the kind of multiples these things are trading at, and you get to like 30, 40 times EBITDA, which ultimately on our ridiculously outsized tail estimates gets you to a stock about $2,000, $2,500 over tail duration. And right now the stock is trading down because people are worried about the sales in the upcoming quarter because freight is stuck on the water and this company doesn't get paid until the consumer gets their product. So this is a perfect example whereby the stock is trading down. You get huge ROIC improvement in the core business. Pod 1 up the wazoo. This is all, again, I'll say it again, unadulterated top-line growth, and it's coming in at a very high margin overseas. And I think you get paid over a trend duration, you get paid over a tail duration, and I just absolutely love this name. I'm not married to it. I'll get off it at some point in time, but I have liked it for a long time, but I think I got a little bit of cred. I've been right. I've been wrong at times. It's been painful, but great stories aren't linear, and that's what we've seen over the past couple of months. The stock has drifted down, and I like it a lot. RH, that's my pitch alongside. Love it.
Professional. How about that? I don't even have time to ask you questions.
Good.
But again, it's in Quad 1. Quad 1 mid caps do quite well. Mid cap growth does really well. So that's both Wynn and RH, two great brands, two great American brands. They're both literally right around the same market cap at 10 to 12 billion. So thank you for that, Mr. McGough. We appreciate it.
Thank you.
All right, on to the next. The Steinbomber, he's known as internally, Josh Steiner.
Good morning. Yeah, so today we're going to take a quick stroll through Coinbase Global, ticker Coin.
I like that.
So this is it's a company that I think a lot of people are pretty familiar with. It came public earlier this year. And I've got a couple of slides, so we'll run through them quickly here. The first slide, slide 26. This is really, if you need to walk away with anything, it's this slide here. And this is the overlay of internet users from 1990 through 2000, overlaid against crypto users from 2014 through 2024. And the point is really that the growth in crypto adoption is tracking essentially perfectly the growth in internet adoption. So we've crossed over the 100 million user mark, which is basically what the internet did in 1997. The outlook is that we're going to be, converging on 1 billion crypto users within 4 or 5 years' time. So, a 5 to 10-fold increase there. And, big picture here, imagine you could sort of jump in the DeLorean and go back to 1997 or 1998, and you knew sort of then what you know today about ultimately the path the internet would take. From a growth and adoption standpoint. So that's really the opportunity here in crypto. And what Coinbase represents is sort of the quintessential pick and shovel play, right? You don't have to bet on a single cryptocurrency or crypto asset like Bitcoin or Ether or whatever. This is really a play on the entire space, growing along this internet adoption curve over the next 20 years. So obviously that's a long-term play. But that is the opportunity here. So we'll flip to the next slide. Now, within that opportunity, you can obviously be opportunistic and risk manage along the way. And there's a tremendous amount of correlation between how Bitcoin trades and how Coinbase performs. And this is a chart from our daily crypto quant tracker product that we put out, which is actually a great product that looks at just shows the performance historically, the expected value by quarter for different quad environments for how Bitcoin has performed. So as you can see, the average return for Bitcoin in quad 1, quad 2, and quad 3 has been between 60 and 100%. That's a quarterly return. Quad 4 has not been kind to crypto. So generally, by using our quad framework, you can really navigate around the crypto landscape, Coinbase included, and take advantage of that 20-year secular opportunity and sidestep a lot of the acute downdrafts that come alongside these quad 4 moments in time. So next slide, slide 28. Just a little bit of an overview. So there's really 2 businesses within Coinbase. There's the retail business and the institutional business. The institutional business is small but growing quickly. But the big gorilla that is Coinbase is really its retail business. And you can see the growth here in verified individual users, monthly transaction, MTUs, monthly transacting users. growing 400% year over year. Transaction volume per monthly user growing. Retail trading volume growing 4, 5, 9, 1,000% year over year. There is fee compression. That's one of the sort of bear arguments about it, but that's really not sort of anything that's terribly surprising. The point is they're growing users and revenue much, much faster, so it doesn't really matter. And at the bottom there, you can see retail transaction revenue growth, 800%, 1,000%, and 300% over the last 3 quarters. And then if we go to slide 29, just to give a bit of a flavor for their role, Coinbase's role within the broader crypto universe. On the left, you can see their assets on the Coinbase platform, obviously growing very quickly. The percentage of the total crypto universe that's residing on the Coinbase platform now up to 15%. That gives them a tremendous advantage for a number of reasons. And you can see where Coinbase fits into the sort of global sphere. They're basically the second largest exchange after Binance, which is based in Asia. They're the largest U.S. provider. Next largest would be Kraken with 1% share, and then FTX US after that. And then finally, a quick slide here, just looking at the use case relative to the other biggest fintech platforms out there. So the chart on the left, these are monthly mobile app users. Data. You can see the largest there is PayPal with a little over 80 million monthly average users, followed by Square's Cash App at about 40 million users. So Coinbase is roughly at 25 million users. So, it's basically the third largest fintech app in the country, actually after just PayPal and Square. So pretty extraordinary momentum there, and obviously a 20-year secular runway. So we do like Coinbase a lot on the long side, and we think with the secular backdrop and the ability to navigate around these different quad environments, we think we give you the keys to be able to do that successfully.
Well done. And again, growth stocks in quad 2 or quad 1 for that matter. And again, a stock like this, it's interesting, just an observation on the shareholder base. There's a lot of wood to chop for people to bring up their positions. Cathie Wood was first at going over 2%. Vanguard's not even at 2% below that. So you got a whole bunch of people that need to buy a whole bunch of this stock. So I like that one too. Nice. And that means the signal likes it, not Keith McCullough. What do I know? All right. What I know is going to be what the Freebird, Andrew Freedman, tells me next.
Here we go. All right. Well, I'm going to pitch quite literally the worst business model I've ever seen and probably will ever see. And so I'm
Twitter?
Yeah, maybe. I'm just on the Fubo train these days. So FuboTV's ticker FUBO. It's a virtual multi-video program distributor or a streaming linear service. It's a commodity service with poor unit economics. They pay out over 100% of the subscription back to the media companies. And on a per unit basis, you're facing rising programming costs. So those costs per subscriber are going up by 5 to 7% a year. At the same time, it is a commodity service, so you have intense competition. Switching costs are very low, so if you don't want Fubo, you can go watch YouTube TV, you can watch Hulu with Live TV. There's also a smattering of other smaller vMVPDs out there. And it's a high churn business model, right? So churn is a feature of this service. So instead of locking into a 1-2 year contract with your paid TV provider, you could just subscribe to FuboTV for $65 a month and just only for the NFL season and then cancel after, which makes it which makes the LTV to subscriber acquisition math very, very challenging. So because of that, ultimately I do think this stock's a zero, which we'll get into in a little bit.
A zero?
Yeah. No, okay. I just think this business will never make any money, and obviously we have to play our catalyst closely. But the way that they're trying to solve the fact that the core business is structurally unprofitable and will never become profitable is by entering new business segments. One of those is sports betting. So they launched a sports book. Took them about 9 months, a little over 9 months to do so, a couple acquisitions to get their sports book launched in Iowa. The problem with that is there's not that many people in Iowa, and the only people that can use the service are those that are current FuboTV subscribers, which they have about 1 million of them. So the chances of them getting to scale, given their subscriber base and where those subscribers are located, is very, very low. And then if there's probably one space that potentially has equal to or potentially worse unit economics than this business. It's actually sports betting, with DraftKings and FanDuel spending ungodly sums of money trying to tackle this market. GLL, our GLL team, Todd Jordan and Sean Jenkins have done a great job on that. So anyway, so that's my pitch for them. But end of the day, I don't think that the sports betting opportunity is real, or it's going to move the needle for them. If it does, it's going to be incredibly expensive and continue to weigh on the unit economics. And then fourth, look, the bottom line here is long term. Like, do you believe that the future of TV is basically pay TV but streamed? I don't think that's the case. I think that the future of TV is going to be you subscribing to Disney Plus, ESPN Plus, Peacock TV, Paramount Plus, all these individual services, which are spending billions of dollars on sports rights and distributing that content exclusively through that. So for example, Amazon snatching up the rights to Thursday night NFL football, you can only watch that on Prime, and that you can't watch that on FuboTV. So I think that's ultimately where we're headed, and that is not good if you're Fubo. Just to kind of go through some of the underlying, math or the data points here, you can see on slide 2 just what I'm referring to in terms of the price not being sustainable, right? Because initially these services were underpriced relative to their content costs and the value, which is why they saw such rapid growth. On the traditional pay TV and VMVPD subscribers, the pricing slide, sorry, the subsequent slide, I'm not sure if I have that slide right. But you could see the historical pricing, underpriced, rising programming costs effectively forces them to raise price in order for them to maintain their currently negative gross margin, which you can see on the slide that's up on the screen right now, that they basically pay out 100% of it back to the media companies when we take into account their lineups. It is a sports-focused service, right? And if you actually look at the content, the sports content is the most expensive content out there, which is not great if you're a Fubo TV, because that means that your costs are going to continue to go up and up and up. And you can see that on the following slide, where we show the 5 to 7% annual increase in programming costs historically for their Fubo TV standard plan. COVID notwithstanding, where there were some RSN credits issued, this is a business that's going to continue to have to raise price mid-single digits in order to maintain their current levels of profitability, or no profitability rather, and that shows up in the cost per subscriber slide, where you could clearly see that they are losing gobs of money on every single subscriber, and this is just not a sustainable model. And what this translates into ultimately is you going upside down on your operating income line. So the more subscribers you get, the more losses you get. There is no scale in this business model, which is why I think it's a zero, and there's no path to profitability here. And frankly, they're chasing a TAM that doesn't exist. I think that they're at about 1 million subscribers as of this quarter. I'll be surprised if they get over 1.5 million. That's usually at the point where we start to see diminishing marginal returns on your growth rate and investment on the subscriber acquisition side, because the market just isn't there. And at that point, growth slows precipitously, and you start to see churn increase because it is a high churn model. And that's how ultimately I think this stock goes to zero. And on the valuation slide, we could say a hypothetical scenario of what do you pay for this if you assume they can get to any type of positive adjusted EBITDA, which I don't think they can, right? So I'm putting this here, I'm saying look, base case it's $17, bear case it's $3. This assumes that they can get to some type of normalized profitability years down the road, but that's not the case. I don't think it's ever going to happen. So this is just more illustrative than anything else. And the last 2 slides just shows that PlayStation Vue couldn't sell their 500,000 subs for $50 million, and that the comp setup's getting worse. The comp setup's getting worse.
First guy.
Growth is going slow. Growth is going to slow. You see it. Okay, sorry.
There you go. He's calling for a zero, and he just got stopped out. Nice.
I hit zero.
Howard keeps it tight. Howard, you might do it in 2 minutes. So Andrew.
I was going to say, I'm happy to give him some of my time. I might, I don't know, but Andrew, if you're still there, no, I'm just kidding. So I'm going to go long, Chef. We put it, Chef, the Chef's Warehouse, CHEF is the ticker symbol. We put it on the long list this morning. A little bit of controversy for me from the standpoint of this wasn't a clear-cut long from the fact that this is a labor-intensive business model, people driving trucks. It's a food distributor business model, so obviously the inflationary pressures are real in the business, but they did put up a good quarter recently, and I think there's a few more of them. So it's not it's not clean because most of the shorts that I have in this space are labor-intensive casual dining business models. But this is a late cycle distributor, if you will. They serve independent chefs, owners, operators of many different independent restaurants, fine dining establishments, country clubs, hotels, caterers, schools, institutions, cruise lines, casinos, especially food segments. You get the story. And I want to mention that part of it because that's important, because if you listen to Andrew and you listen to Todd previously, there's a piece of this recovery story that has not played out yet in a lot of those establishments. So they're seeing about a third of their business is still seeing, opening up, if you will. And that's part of the reason why they had a great quarter and part of the reason why they're going to have another good quarter. But there's a couple of elements here that I just want to point out. And most importantly, Keith, it is a quad 2 and a quad name, which if you want to go to the last chart, sorry, I put those up at the end. So this is a perfect setup from a quad 2 standpoint, Keith, and into quad 1 into next year. So from a factor standpoint, really like the name, like the fundamentals of it, as you can see on slide 44, Eric, just a nice trend in upward revisions in revenues and EBITDA and earnings. And I fully expect that to continue. This is a family-controlled business. You have the CEO and chairman owning 8%. He did just sell a chunk of stock, but it also is important in the context of the M&A cycle. So he recently just bought 2 companies that they're going to be folding in, and these are more tuck-in acquisitions, not sort of game-changing acquisitions. And that's part of the story that they've been able to execute on over the last 5 to 10 years that they've been a public company. So the M&A cycle, the opening up of casinos and cruise lines and an element of the economy, and then you still have it is a little expensive from a valuation standpoint, kind of the middle of the road where it's traded historically, but I don't mind that because I think the earnings are low and I think the valuation can go up. And then you do have the potential for a little short interest covering as we get some better numbers here into the first half and into the fourth quarter and into the first half of next year. So definitely a quad 1 name, Keith. Love Chef, CHEF.
Look at that. He did it in 3 minutes. See that? Now we have some time for some questions. What's the deal with, it caught my eye actually, and it's a good thing you mentioned it like a pro would. Insider sale by a gentleman by the name of Pappas. It looks like, is it he and his brother that both own over 10%?
Yeah, so it's the founding family. He owns 8% of the company. So it's not a big deal that he sold. He did. So I noted that it's important, but it doesn't mean anything. I frankly, if you see the note that I wrote out this morning, I was speculating that he frankly could sell the company. He's 61, so he's of that age, right? Just came through the pandemic. The company's in a much better position than it was entering the pandemic. So great time to sell it. But then you could also say, why would he sell it after he just sold a bunch of stock? So. But not a concern. I don't really see that as a big
I don't think a capitalist sells $10 million worth of stock if he's going to sell the company for a higher price. That's not going to. That doesn't float in my world in terms of intuition. But that's good. Good. All right. Thank you, sir. Appreciate it. Now we got. I don't want to call you a rookie. Is it your first time on the pitch?
It is my first time, so I am technically a rookie. But if I earn my way out of it, I'll take it.
Yeah. For those of you that don't know, Rob Simone, he needs no introduction. By the way, for everyone, including Penny, everybody's already gone. He has the Consumables Pro product. So again, Rob has the REIT Pro product. Pro means that you don't pay the institutional price and you can get all their ideas, best ideas, rank ordered ideas, long, short ideas. So far, we only have one short idea with Freebird, but fire away.
Sure. So I'm here to talk about American Homes for Rent, AMH. It's been on my long list for a while. The story is really simple here. My first slide, slide 49, I lay out kind of just a brief overview of what the company does. But really what this is about is an accelerating rate of change and consensus estimates that are just way too low. And I'll get into that in a second. From a quad perspective, I don't have a slide in my deck. However, I did look it up. It appears at first glance like AMH is a pretty poor quad 1 performer. But from a backtest perspective, there's actually a limited data set, given that it just came public a couple of years ago. If you look at the broader resi space, Quad 1 is actually the best quad for residential, of which AMH belongs. But I'll get into the thesis really briefly. I could probably stop at slide 50 and just show this one slide. The way to think about resi, and specifically single-family rentals, home price appreciation leads what are called leasing spreads, which leads actual rental rate growth that shows up in AMH's numbers. Leasing spreads are at a point in time, the change in the rate of a new lease signed versus the old lease for that same unit. That lags HPA, or home price appreciation, by about 3 to 4 quarters. My colleague Josh Steiner has talked about that frequently. And then it takes another 2 to 3 quarters plus or minus for that to really flow into the results. What I have here on slide 50 is a lagged chart of HPA against leasing spreads, which shows about an 80% correlation. You don't have to be a genius. I don't have to be a genius to look at this chart and know where spreads are heading from here. They're headed higher. Slide 51, I have in my model, for the purpose of being conservative, I've actually showed a decel in my leasing spread number, again, which will impact the actual numbers on a lag. I'm being overly conservative. I can tell you the consensus, which is 10% below me, is absurdly conservative. There's a strong case to be made here for a rate of change acceleration through 22, maybe into 23, on all the key metrics, and at the same time, numbers are going to be coming up. That's a great position for what I think is one of the most interesting tail duration long calls in my space. Slide 52, I like breaking down things into the component parts to sanity check the numbers. This really shows the evidence or the backup as support for my numbers, which are above consensus. And then briefly on slide 53, if I could, the valuation case here is interesting. I've spoken about this before. I actually prefer companies that do not show big discounts to NAV. Usually in the REIT space, what that means is that there's some type of dislocation or impairment of the asset class. Interestingly enough, for AMH, you can actually, using an HPA index, market by market, come to an estimate almost on a real-time basis for what the homes are worth. And what you see is a stock price that is trading at a slight premium to NAV, which this is kind of like sacrilege in the REIT space under traditional methods. I actually love. But what's really key here is to think about a portfolio that's earning 6% returns on capital versus a 4% cost of capital implied by the stock. So what that means is you're going to be growing NAV on a forward basis as opposed to a point in time. So the forward-looking metric is really what to think about here. And the catalysts I mentioned earlier are really what catalyze that growth. So that's all for me, long AMH.
Now this one, really interesting because it's not like Coinbase is pointing out that Vanguard just started to buy it, but in this case, Vanguard owns 11% of it. It's become part of a lot of the REIT indexing, et cetera, if only because it's such a unique asset, right?
Yes.
There's not that many of them.
It's one of two.
So when you said that it's kind of sacrilege to look at the valuation that way, what do you mean?
Well, the traditional methodology, especially on the sell side, is to calculate subjective NAVs for all of your stocks and kind of rank order them on premium and discounts, with the discounts kind of gravitating to the top of the list as most attractive. But what really happens is you buy these stocks that are impaired, kind of like retail malls, office names at big discounts to NAV, and you lose a bunch of money because the asset class is impaired and not growing. So it's really telling you something.
I would be just a natural sacrilegious person in REITs because they're like value traps. I mean, expensive is going to get more expensive, cheap gets cheaper.
Yep.
That's how we roll. So that's probably why we're rolling together these days. Any risk to other market caps coming public that want to do this? Obviously, that it receives a bit of a premium because it is such a scarce asset.
I think there is, but on a longer tail because the other competing platforms that could reach the scale are just starting to form.
Right.
So there's lots of private capital that's entering the market, and by the way, looking for experienced third-party management potentially. So think like Nuveen, CPPIB, Blackstone.
Cerberus.
Cerberus. They pour a bunch of capital in, they build a portfolio, but what they really need is on-the-ground management.
Yep.
There's an opportunity for AMH and its peer INVH to lend that and earn fees in exchange for doing so, which is actually like another ancillary revenue stream, which makes the platform more valuable. So for a time, it's actually an opportunity.
Really good. And it's in my sweet spot of market cap for Quad 1. Again, you're going to get used to hearing this in Quad 1. Mid cap is the sweet spot. That doesn't mean sell everything, by the way, if you guys want to show slide 7, we show the quarterly returns. Again, expected returns, pretty much everything goes up in quad 1, all right? Everything, including Rob's space, because interest rates stopped going up. All right, thank you, sir.
Thank you very much.
Appreciate it. All right, right to the Felix. Haven't seen you in a couple weeks, man. You look good.
Hey, Keith. Same to you. I'm hanging in there. So my pitch today is on long NetEase, ticker is NTES. NetEase is the second largest video game developer and publisher in China, only behind Tencent. There are a couple of new games by NetEase that have exceeded expectations and revitalized its growth potential. The first game is mobile game, Harry Potter Magic Awakened. As a good luck charm, I bought this little holiday owl here, who's a close companion of Harry Potter, called Hedwig the Owl. He's also a big fan of NetEase. So I think this new.
Oh, there you go. Okay, that looks better. Okay, keep going.
Yeah. So I think this new Harry Potter game has potential for NetEase to really cater to a new casual gamer segment. And their ARPU may be lower than the hardcore gamer out there, but it can really scale up. Harry Potter is also doing well overseas and recently launched in Hong Kong, Macau, and Taiwan. Thus, it has global aspirations. I expect NetEase's domestic mobile game market revenue share to continue to rise, helped by this game. The second game on the next slide that has exceeded expectations is Naraka Blade Point, which is a battle royale PC game. So because of this game, NetEase PC game revenues have soared in Q3. It was its highest revenue growth rate since Q1 2019. And I'm excited to see what Naraka has in store next year as it expands to overseas markets and may even have a mobile version. Finally, on the next slide, the mobile game I'm waiting for especially is Diablo Immortal. I've talked about this many times. This game should debut sometime next year. I remain optimistic on this game, Diablo. That title now has a better shot of debuting, given that new game approval should resume at some point early 2022. Diablo already has an approved game license, but are stuck in this current regulation approval process. Keep in mind that NetEase's games in general is in a better state than Tencent with regard to the regulatory headwinds out there in gaming. So that's on the game side. On the next slide, I'll briefly discuss the music side for NetEase. So their music segment, Cloud Village, aka Cloud Music, is IPOing this tomorrow night in Hong Kong. I'm actually doing an updated deep dive on that name tomorrow. Given changes in the music regulatory environment, Cloud Village definitely seeks the benefit here. China's anti-monopoly regulator, SAMR, forced Tencent Music to lift its exclusive copyrights, which accounts for about 1% of its total music copyrights. But this 1% is a big revenue driver, given that it includes many of the superstar artists like Jay Chou and Mayday. So in recent years, SAMR and also the National Copyright Administration, or NCAC, basically have been paying very close attention to these exclusive licenses in music. So what did Tencent Music do when they received this? They complied with the request. Meanwhile, Cloud Music also, as you can see on the slide, also issued a response, even though the regulation isn't really directed at them. Cloud Music also has some exclusive deals, but it pales in comparison to what Tencent Music already has. Furthermore, SAMR has said that China's online music copyright billing model is unreasonable and the guarantee royalties are too high. So what does this mean? This means that the license costs will be monitored and will eventually fall. So that's a positive. As a result, Cloud Village probably is smiling after this regulatory change. Keep in mind, when you rewind back a few years, there was a big copyright dispute between superstar Jay Chou's songs. That uproar caused Cloud Music to remove all of Jay Chou's songs from its shelves and grade out its songs on the platform. As a result, for those Jay Chou fans, they had to switch to Tencent Music to listen to Jay Chou. Now Cloud Music or Cloud Village has a chance to recoup some of those lost users. And then the final slide. So when we talk about Cloud Village here, what do they inspire and keep music lovers on the platform? To me, it's all about building connections. So the recommendation engine from Cloud Village has been very useful in introducing music lovers to new songs. Meanwhile, the comments section right below their music player promotes a lot of engagement. The comment section is probably Cloud Village's most noteworthy advantage. As for the independent musicians, Cloud Music has a variety of AI tools and services to help them improve their music making abilities. This is why Cloud Music has been able to attract many independent artists. Overall, I see good growth for Cloud Village. So that's some of my bullish points for NetEase.
Well done with the prop. You know, people want to get long the Potter Owl. They want to get long the Diablo. You gave them plenty to think about. A lot of people aren't long the stock, by the way. There's that damn owl again. Now I got to watch that.
Yes.
He's got a bird, a live bird. He's got an owl.
As you can tell, I'm a bird fan. Any kind of bird.
Yeah. All right, thanks, buddy. I appreciate it. Tom Tobin, welcome.
Right. Hi, how are you?
I'm, getting along.
All right, good.
Go for it.
Well, this might annoy you a little bit because I know you had this in.
I got to put it back in. It
Yeah,
sounds
you
like.
got to put it back in. AMN on the long side.
Oh, good.
Been doing a lot of work around this idea of labor scarcity. How to play it both on the long and the short side. Just in the initial phases here, we're just going back through a few of the items on the first slide there. You can see just the overview of where we are with AMN. I think this thing could trade up into sort of the high 100s. And I feel like I'm, in terms of the model that we built out here, there's a lot of incremental upside. So this is just the stat sheet on AMN and how we get there. You can see the estimate trends on the bottom right-hand corner there, boxed out for you. So we're significantly higher for that 2022, but I think the key element here on the next slide is really the reason why I think the stock is somewhat understood, or less so now than it was 6 or even 12 months ago, is really on the next slide in terms of where the estimate trends are. So you can see that people thought that 2021 was going to be the peak. They had down revenue in 22, 23, et cetera. That's all tightened up here since their last quarter. And I think what's becoming more, it's the next slide, yeah. So what's really becoming clear is how permanent or semi-permanent this labor inflation componentry is. So on the jolts and quits, you can see lots of people on the jolts data is up and to the right, quits up and to the right, I think in the slide before that. So we're at 3 standard deviations here. We think about it on the next slide in terms of healthcare labor demand, so it's the combination of hires and openings. It's near an all-time high right now, and on a rate of change basis, still very positive. We think the medical demand piece is starting to accelerate, partly because people stayed away from the doctor for such a long time during COVID, and they continued to do so. So there's this incremental demand that's building up and building up and building up, and we've quantified it in terms of aggregate hours. So if people don't go to the doctor, they're not going to see a nurse or a doctor or part of the healthcare system, which is delivered by people still. And what you're seeing on this slide is that this incremental is going to be, to service it all in a month would take you about 2 billion hours, which is, a lot. Obviously, about 13 million people relative to 17 to 20 million people that are currently employed. So we have a lot of backlog to work down. Some of the indirect evidence is that people are showing up really sick, which is in the lower right-hand corner there. People are going in with later stage cancers, more advanced cardiovascular disease, et cetera, et cetera, et cetera. So it's out there. The other piece is, and this is just the headlines that have been coming through. We've been putting this in our morning notes, so almost daily now, that a lot of hospitals are really struggling physically to stay open. Clinics really need these bodies to essentially see these patients, keep the patients flowing, and it's happening at an accelerating rate. The interesting part here that's a little bit incremental to what we're saying, what the broader market view is on this Google Trends for travel nurses. So a travel nurse can make a lot more money than they can make at a full-time job. What they're doing is that the nurses are leaving their full-time job to go travel to make a lot more money. They're getting paid sick wages to do this. So it's actually inducing more people to leave their permanent placement job to go travel. this cycle, I mean, this is kind of crazy to see the interest in travel nursing move higher like that relative to where it had been for a really, really long time. This is not a new function. I mean, nurses have been traveling for 13-week gigs for a long time. In this instance, it just looks like those wages are inducing a lot of people out of the full-time labor supply, which is inducing more labor inflation, which is inducing more flight, right? So this is a cycle that's happening you can see that already occurring here. Just in the last couple of months is taking off on the wage inflation chart. General medical surgical hospitals at 8-9%. It's not happening so much for med labs, which I think have already been through the cycle, so we're still long DGX here. But for hospitals and for physical plant, you're having a tough time keeping people. We're also seeing it in the AMN pricing on our own tracker data up into the right into Q4. Again, thinking this through, what the company's saying, hey, we're going to be down on pricing. We're going to revert to something higher than 19, but below pandemic peaks. That doesn't look like the case, right? So if that continues, you end up, volumes going up, pricing's going up, revenue's going up, and depending on how long it takes that pent-up demand to work down, we're going to be in this heightened demand situation, heightened pricing situation for a long, long time. In terms of the metrics for AMN that matter, and I think this is interesting too, relative again to 2 billion hours on the sidelines that we need to draw in to service all this demand. We're talking about 10, 15, 20,000 FTEs in the field at any given quarter. That's tiny, right? So the incremental demand versus what they can supply, where this pricing ends up, not like temp staffing is a new thing or an old thing, or it's just grossly mismatched with what the demand situation is. And this is one of the purest ways to play it. And I think, yeah, sure, the stocks run a lot. We've been long for a little bit here. But I think up and to the right is where this thing's going. When we think about the valuation table, the scenario here, this is how we get there. If you just look at that 2022, 2023 box, I think we're going to end up down and to the right on those corners. Pick a number, right? So is it 165? Is it 170? Are we going to think about 2023 or 2022? And then also our numbers are probably low. I think, plus 4 billion is definitely in the cards. And that's it.
Awesome. This one, trend is 104. So just as a matter of process for people that pay for our investing ideas product, as Tom said, I took it out because I got stopped out at 104, but then you're back in at above 104. It's at 115, like you said, could go a lot higher. And again, another sweet spot in terms of market cap. So thank you. Appreciate it. Right on time here. Ami, you're going to keep us on time. We've only had one buzzer.
On time. Never heard of it. What's going on, Keith?
How you doing?
I'm pitching Qualtrics today on the long side. I got 3 key takeaways here that I want to start with. Number one is that it's not the first time that Qualtrics has been doubted before, and in the past that hasn't been a good bet. The company has proven itself to be a sustaining better than 30% grower and to open new markets. I'm going to show you a couple things. Number two is that we think they are underpenetrated, and number three is that they care about profits and cash flows and they're on their way there. Just separates them out from some of the other companies in my space. So let's take a look at slide 78. You can see they dominate the category. Slide 79, this on the left-hand side is the number of features that they release per quarter. Our team, we track this internally pretty carefully for Qualtrics. And the reason is because Qualtrics, they were originally survey software. So they were doubted, it's just survey software. Well, they kept at it with the technology additions on feature and functionality, and they kept churning that butter. And guess what happened? They became data insights and analytics for customers and employees and brand and product, et cetera. So they made themselves into something much better. And guess what? They keep churning that butter. So what are they going to become? They're going to become something even better, something even more. Technology is all about supply growth. The more supply of technology you put into the marketplace, the more demand you create. And so we really like this curve for Qualtrics, and we cover that very carefully. And that's also why they've come to dominate their space. Look at the next slide, slide 80. This is Qualtrics against their 2 largest competitors or most direct competitors, which is SurveyMonkey, now called Momentive, and Medallia. These are the 2 most direct competitors today. Qualtrics now has $1.1 billion of run rate revenue, growing over 40%. And these 2 others have $1.1 billion of revenue, growing 18%. Qualtrics has trounced them in the last number of years, and there's still more of that to come. If you look at the next slide, slide 81, This is by the end of 2020. By the way, if we're going to update it again at the end of 21. But if I just kind of give you you'll see a few slides later on, Qualtrics has accelerated in 2021. But comparing Qualtrics' position with customer engagement data and insights and analytics, you could see that this space is rich. There's a lot of companies who want access to this stuff in this category, and there's a lot of room for them to run here. They are underpenetrated. If I look at slide 82, they recently made an acquisition called Clarabridge. So Qualtrics, as I mentioned, is data and insights. Clarabridge adds to that. There's more data. There's also fine-tuned insights. You can see some of the quotes on the right-hand side. But the question is, when you have really good customer data and customer insights, what could you do with that, right? You could become, I'm just spitballing here in this slide, but you could become prescriptive. You could become relevant in marketing automation. You become relevant in sales pipeline. You can be even relevant from the employee side in org structure analysis and HCM. So all of those things are all upside for them to extend and grow functionality and become wider and wider of relevance. And you can see that they keep churning that butter. They keep creating more and more feature and functionality. And by the way, that resonates in customer interviews, it resonates in product reviews, it resonates in employee reviews. So that emphasis of the company flows right through everything that we study about Qualtrics, and will continue to mean that this company ends up growing faster than most people think on a forward basis. If we look at the next slide, slide 83, you could see they're also starting to care about operating margins and operating cash flows, and that's starting to get better. If we look at the next slide, 84, I don't want to give you something that's about to puke. So let me take a look and see how are they doing right now, 2 months into the fourth quarter. And the look on the left-hand side, this is how we track customer additions. So the black line is total LTM downloads. The blue line is year minus year customer additions. And it looks pretty good. And if you look at the right-hand side, what it implies on a quarter-over-quarter basis is a continuing acceleration of sequential customer additions. So they continue, the adoption curve continues to accelerate. These are good numbers. When I saw these numbers for the first time yesterday, and I went into the model and so on and so forth, I was pretty pleased with these. These are good numbers. So if we go to the next slide, slide 85, you can see the market is doubting Qualtrics, assuming that it's more like, if you kind of do the line across there, more like a 20% grower. And we think on a forward basis, it's better than 30%. So if we're right on a forward basis, we're going to get positive estimate revisions, and we're going to get an improvement in the multiple, or at minimum, we won't have any more multiple step down. So the pressure on Qualtrics over the last couple of months, see it, the doubting is there, not immune to it, but I'm telling you, the work, the research, the analysis, this company continues to open up more and more market and to dominate the markets that it's in, and they are underpenetrated, and that will, on a lag, translate to profits, as they are already showing incremental profits and incremental cash flows. And that's all for me on Qualtrics.
Underpenetrated, underowned. It's interesting. I mean, Silver Lake, they have that 6% position. I guess that's probably legacy. Tell me yes or no. And then Tiger Global is actually their number one holder, which it's rare to have a hedge fund at the top. But Tiger's rarely late. I mean, they're a leading indicator, not a lagging one.
Yeah, I think that the ownership stack here is going to improve a lot. SAP owns 80% of the company still, because they had acquired the company a few years ago and then spun it back out. So that is definitely, as SAP unlocks, I think there's going to be a lot more. They're going to build shareholder accounts here that are going to be much larger. The Silver Lake one is from the timing of the acquisition and from the IPO, actually.
But look at that, right on the screws. You nailed it. Thank you, sir. I appreciate that. And that's another sweet spot market cap, right around $17 billion in cap. You get another bite at the apple on that one if you risk managed it appropriately. Jay, you get to finish up here, man.
Great. Thank you, Keith. And thank you, everyone. So I'm going to do a short idea, which is new in terms of what we've pitched, but it's Rollins. It's in a mature and fragmented industry, and it has a clear series of catalysts. And what I think makes it particularly interesting is that those catalysts are already in motion, right? It's already happening. So what is Rollins on sort of that first pie chart slide? It's a pest control company, the Orkin Man, right? It kills termites and bugs, and it's supposed to be a growthy roll-up, right? And what, anytime you have a mature industry like that that's supposed to be a roll-up, there's an issue. But the holders are typically growth investors, right? When you look at who they are. And the roll-up story, which is supposed to be doing these acquisitions by gobbling up smaller competitors at a clip of 10 or 15 a quarter. It means that acquisitions are incredibly important to the story, and how you account for them is important. And sort of on that, the next slide, the overview, can go to that. These investors, they think they're getting this deal, this underlying, deal growth plus organic growth, right, which is supposed to be mid-single digit, because that's what the company's been telling you for a long time, underneath, and you get this great growth story. But for some time, it has been very difficult for us to get those numbers to match the narrative, right? They just don't. You have a hard time adding it all up. And adding to that ambiguity is the fact that it's controlled by, a fairly inside board in the Rollins family, which has its own version of Succession, the HBO show. One patriarch has passed away. The second is in his late 70s and missed the last earnings call, which is the first time I can find, which is amazing since he has an accounting scandal and he misses the earnings call. And the next generation, which inherits this company's control, basically, has been boxed out. And you can read a whole colorful set of complaints and litigation from a few years ago about how that's going. If you're wondering if when Gary Rollins passes away, it's all going to be good. It's not. It's not going to be good. It's also a route-based logistics company, right? They drive around and spray people's houses. And you see fuel and labor dominate operating costs, which means it's a terrible quad 2 performer, right? That margin pressure should come through and hit in fourth quarter and into 2022, which coincides, which is the key part of this, which is the accounting and disclosure part of the thesis, which is just amazing, right? In the first quarter earnings report, in the next slide, you can see they basically admitted to fudging organic growth numbers, right? Leaving some acquisitions in. They suddenly end up with this significant definition, which remains ambiguous. Nobody knows what that means, but those insignificant acquisitions are still in organic growth, which is literally not how anyone understands organic growth. And you can see they try to explain it, and they basically are like, if I do it quickly, then it doesn't matter, right? I can leave it in organic growth, which is just not how anything works at all, right? Like, just because you close an acquisition quickly doesn't mean that you can just leave it in organic growth. And it's important to remember, when you look at this is a company that has an active SEC investigation, and it's into accruals, which is the kind of accounting public companies use, very broad. And as of now, even though this is from first quarter, they still haven't defined that. And then if you look at the next slide, right, there is this issue of organic growth, right? And organic growth has been remarkably stable, right? You can see Terminix on the right there, you can see Terminix compared to Rollins. And for years, Rollins has produced this precisely, almost manufactured, steady organic growth in an industry that isn't necessarily, is affected by weather and all kinds of other factors. And then it turns out that, maybe that wasn't organic growth. And again, they have yet to clarify that. And if you look, so after the first quarter earnings call, the day before the second quarter earnings call, the CFO, he wasn't fired, but he was instead moved to a sustainability role at a company that sprays people's houses with pesticide for a living, right? That's not exactly a sustainability mecca. And if you look at the next slide, you'll see some of the issues around purchase allocation. This is a bigger conversation, but if you buy a company and you sell it a year later and you have a 50% gain on what you bought, I have some questions about your purchase price allocations in the acquisition. Clearly there's some favorable estimates going on, right? And that's in the control of management in the acquisition process of a company that does 10 or 15 deals a quarter. And if we look at the next slide, you can see that it isn't that Rollins is some kind of amazing brand. Actually, Terminix surveys better, and there isn't a lot of price. So it isn't like fuel prices are going to go up or I can take a lot of price. It's a price sensitive market. So just to summarize, you have an acquisitive company. You have an acquisitive company who's heading into the year-end audit, which is a great catalyst, filing the 10K. You have investors that are looking for clarification around these very central investment issues. And you have a number of new board members that I think are pushing some of this activity. And you have a stock that's about to get, the company's about to have margin pressure from fuel and labor, but also is trading at 55x and probably belongs at more like 15x. So I think as this sort of plays out and the quality premium comes out of shares of Rollins, you could see this have 50-60% downside pretty easily. And that's it.
I can't find any of what Jay just said from their investment bankers. It's the oddest thing. Thank you so much for enlightening us, and to all the analysts for getting it done. 10 ideas, 60 minutes. That was the pitch.